The stock market. A realm of opportunity, a source of anxiety, and a topic of endless debate. Today, the conversation revolves around one question. Why are stock market valuations so high? It's a question that has investors both excited and apprehensive. On the one hand, soaring stock prices can signal a robust economy and strong corporate profits. On the other hand, when valuations reach dizzying heights, it's natural to wonder if the market has become detached from reality. Are we in a bubble on the verge of bursting, or is there a fundamental shift that justifies these lofty valuations? Let's delve into the heart of this conundrum. The U.S. stock market in particular has been on an impressive bull run for over a decade. While this ascent has created immense wealth for many investors, it has also pushed valuations into uncharted territory. One widely used metric, the market cap to GDP ratio, paints a stark picture. This ratio, famously favored by Warren Buffett, compares the total value of the stock market to the size of the economy. Currently, this ratio stands well above its historical average, exceeding even the levels seen during the dot-com bubble of the late 1990s. Another indicator, the price-to-fair value metric, also suggests that the market is trading at a premium. This metric, which compares stock prices to their intrinsic values, currently hovers above 1.0, implying that stocks are, on average, slightly overvalued. While these metrics don't necessarily spell doom and gloom, they do raise a red flag for discerning investors. No conversation about stock market valuations would be complete without acknowledging the elephant in the room: technology stocks. The tech sector, home to giants like Apple, Microsoft, Amazon, and Alphabet, Google's parent company, has been a major driver of the market's upward trajectory. These companies, with their global reach, innovative products, and seemingly limitless growth potential, have captured the imagination of investors worldwide. Their massive market capitalizations have significantly influenced overall market valuations. Some argue that the tech sector's asset-light nature, meaning they require fewer physical assets to generate revenue, justifies higher valuations. However, others caution against double-counting their strength, as their impressive profits are already reflected in their stock prices. While valuations provide a snapshot of the market's current temperature, it's crucial to remember that investing is a long game. In the long run, stock market returns are inextricably linked to earnings growth. When companies generate profits and those profits increase over time, their stock prices tend to follow suit. Recent earnings reports have painted a mixed picture. While many companies managed to meet or exceed earnings expectations in the previous quarter, their forward guidance has been more cautious, citing concerns about a potential economic slowdown. This disconnect between past performance and future expectations adds another layer of complexity to the valuation puzzle. Section 5. The bond market speaks, a shift in the tide. The bond market, often seen as a more sober and rational counterpart to the stock market, can offer valuable insights into investor sentiment. Bond yields, which move inversely to bond prices, reflect investors' expectations for future interest rates and inflation. When bond yields are low, as they were for much of the past decade, investors are essentially saying that they expect economic growth and inflation to remain muted. This environment of low yields can make stocks appear more attractive, even at elevated valuations. However, recent trends in the bond market suggest a potential shift in the tide. Bond yields have been on the rise, indicating that investors are anticipating higher interest rates and potentially a resurgence of inflation. This shift could have significant implications for stock market valuations, as higher bond yields can make stocks appear relatively less attractive. Section 6. Sector Spotlight: Winners and Losers in the Valuation Game. Not all sectors are created equal, especially when it comes to valuations. While some sectors are basking in the glow of high valuations, others are languishing in the shadows. This disparity highlights the importance of diversification and sector-specific analysis. Currently, sectors like technology, consumer discretionary, and healthcare are trading at relatively high valuations, reflecting their growth potential and perceived resilience in the face of economic uncertainty. On the other hand, sectors like energy, materials, and financials are trading at more modest valuations, potentially offering investors a margin of safety. This is not to say that all high valuation sectors are overvalued or that all low valuation sectors are undervalued. However, understanding these sector-specific dynamics is crucial for making informed investment decisions. Section 7. Navigating the high seas investment strategies for uncertain times. So, how should investors navigate this environment of high valuations and uncertain economic prospects? Diversification, the age-old adage of not putting all your eggs in one basket, remains as relevant as ever. By spreading your investments across different asset classes, sectors, and geographies, you can mitigate the impact of any single investment going sour. Another strategy is to focus on undervalued sectors or companies that may be overlooked by the market. These value plays may not be the flashiest names in the headlines, but they often offer attractive risk-reward profiles. Remember, investing is not about chasing the latest fads or trying to time the market perfectly. It's about identifying sound businesses with strong fundamentals and holding them for the long term. Section 8. Recent market tremors, a sign of things to come. The stock market is a dynamic beast, prone to bouts of volatility and uncertainty. Recent market events have served as a stark reminder of this inherent unpredictability. Geopolitical tensions, rising inflation, and concerns about a potential recession have all contributed to market jitters. The Federal Reserve's recent interest rate hikes, while aimed at curbing inflation, have also raised concerns about their potential impact on economic growth. These events underscore the importance of staying informed, remaining disciplined, and avoiding emotional investment decisions. Section 9. Conclusion. A balancing act. Risk and reward in today's market. The stock market is currently engaged in a delicate balancing act. On the one hand, strong corporate earnings, technological innovation, and a relatively healthy economy provide reasons for optimism. On the other hand, high valuations, rising interest rates, and geopolitical uncertainties inject a dose of caution into the equation. As we move forward, investors will need to weigh these competing forces carefully. Remember, there is no crystal ball that can predict the market's next move with certainty. However, by focusing on the fundamentals, diversifying your investments, and maintaining a long-term perspective, you can navigate the market's twists and turns with greater confidence.